Enron was an energy trading and utility company based in Hudson, Texas, that was committed one of the biggest accounting fraud in history. Enron accounts was manipulated a huge amount of debt that were hidden from the company's balance sheet, they misreporting income and creating off-balance sheet entities to hide debt and presenting a positive picture of the company's financial health. In the third quarter of 2001, Enron announced of $638 million loss and $1.2 billion reduction in shareholders' equity. That made one of the biggest bankruptcy in history. Over 20,000 employees lost their jobs, investors lost money, and people lost confidence in corporate governance and leading to the regulatory reforms.
Let's go through the ethical analysis of Enron's scandal. Some of the ethical analysis we collected are lack of transparency. Lack of transparency in its financial reporting and operation. They use complicated financial structures to keep key details hidden from investors and regulators, making it so difficult for outsiders to understand the true financial health of the company. Next is conflict of interest. The executives made decisions that benefited themselves personally rather than prioritizing the company's well-being and the interest of shareholders. Enron's corporate leaders did not have a culture of integrity, honesty, and accountability, especially in their decision-making process. And lastly, we found out that there was a mispresentation because they used complex accounting tricks to make the company appear more profitable than it actually was, like hiding debts and inflating earnings. The negligence of ethical consideration are very crucial in decision-making processes and also towards the core business values.
Next, for governance analysis, we found out that Enron's lack of accountability and responsibility, organizational culture where employees and independent boards perform poor ethical business. They tend to feel smarter and better than others. They also think that they can do anything they want without thinking of any consequences and side effects towards the organization. The tops of Enron's executives also act for their own interests. Next, financial disclosure failure and fraudulent. Enron executives create fraudulent accounting practices, manipulating the financial statements to create an illusion of profitability. They hide the losses that happen in their organization by making accounting tricks. Enron presented financial statement in profitability even when it had millions of dollars in debt and losses. And the last, failure of the board to oversight. Enron's board of directors failed to oversee the company activities and hold the management accountable. The board lacked independence and it was influenced by conflict of interest and did not exercise sufficient skepticism. The board also is composed of a number of who lack moral character. This act will make the situation even worse.
The first lesson learned is importance of transparency and accountability, which the Enron affair highlight about how important it is for business to be transparent and accountable in order to stop scams like this one. Other than that, it protects shareholder value, which business must utilize in their shareholders' best interest and give priority to long-term value above short-term earnings. Lastly, strong regulation and oversight, which the crisis serve as a reminder of how crucial strict regulation and supervision are in stopping corporate wrongdoing.
Furthermore, I will explain the recommendation we can get from the Enron scandal to prevent it from happening again. Firstly, ensure transparency. Company must disclose information about their financial health to increase transparency in the operation and management, to make it easier for investors to make informed decisions. Mandatory full disclosure of balance sheet items, company transactions, and other potentially misleading financial arrangements to reassure shareholders. Next is to improve corporate governance. The audit committee management and the BOD board of directors must ensure to have no relationship with each other, and to enhance whistleblower protection, to encourage reporting of unethical practices without fear of retaliation or counterattack, and increase the likelihood of detecting fraudulent activity early. And lastly, we can recommend to implementing a strong regulation. Regulatory body must conduct routine inspection and evaluate the company to stop financial frauds, and charging severe penalties for breaking the law in order to prevent firms from committing fraud.